Hello everyone, welcome back. In the accounting equation part 1, we went through the fundamentals in accounting equation. Let's look at how we can record business transactions in the accounting equation. All the possible questions will be discussed in 3 short tutorials. In the first tutorial, we'll look at a few simple business transactions in a startup business. Before moving to the transaction analysis, I want you to remember 4 easy steps. Of course, first we need to read the transaction. A quick recap from the last tutorial, I told you that there are non-business transactions as well, such as personal transactions and business events. But in accounting, we only record business transactions that affect the assets, liabilities, and equity items in the business. Secondly, the application of duality. We discussed about the duality concept as well. Every transaction has a dual effect on the accounting equation. By telling so, every transaction must be recorded at least in 2 accounts. For that, we need to understand those affected accounts. Then we need to see the impact to those affected accounts, whether the transaction is having a positive or a negative impact on their balances. In other words, we need to see whether those account balances are increasing or decreasing as a result of the business transaction. So in the accounting equation, we use plus or minus signs to depict increasing or decreasing effects. Finally, we want to ensure left-hand side of the equation is equal to the right-hand side of the equation after the application of duality in dollar terms. Let's focus on our basic accounting equation. Assets equals liabilities plus equity. Also, we need to consider income and expenses. From the definition, we know that income resulted in increasing the equity, whereas expenses resulted in decreasing the equity. So we need to keep that in mind when recording income and expense items in the equity column. Keeping these 4 steps in mind, let's go and analyze business transactions. The first illustrative example is capital contribution by the owner. Owner contributes 10,000 of his personal savings into the business bank account. So now business will have assets of 10,000 in cash, which also represent 10,000 owed to the owner. That means equities are the internal claims of entities' assets. I have often seen some students used to think this increase in equity is due to increase in the income. But when we are looking at the income definition, to recognize an income that should be other than those related to equity holders' contributions. Therefore, owner-related transaction shouldn't be considered here. Let's see how we can record capital contribution in the accounting equation. So the accounting equation would record the impact as increasing cash asset by 10,000, which is a plus, and increasing in equity by 10,000, which is also a plus. Finally, we need to ensure total assets in the left-hand side of the accounting equation equals to the right-hand side claims on the assets. Owners can also bring personal assets to the business. In this example, owner contributed 20,000 worth of personal vehicle to the business. It has the same effect as in the above example, but instead of cash, now it increases the vehicle asset by 20,000 and increasing in equity by 20,000, which will then balance the accounting equation. In the illustrative example 2, we are looking at capital withdrawals. Owners can withdraw cash from the business for personal use. In this example, withdrawing cash from business will decrease the cash asset. It will also decrease owner's claim to the business entity. Again, withdrawal shouldn't be considered as an expense, although it decreases equity. The expenses definition says to recognize an expense item that should be other than those related to distributions to equity holders. So we record withdrawals as decreasing cash asset by 3,000, depicted by a minus 3,000, and equity also decreased by 3,000. From these two examples, we look at increasing and decreasing of the internal claims of the entity's assets. Next, we'll look at the external claims. In the third example, we are looking at acquiring a business loan. Business borrowed $15,000 from Citibank. It impacts on increasing the cash asset because bank given you money as a loan. So it also increased the obligation to repay the loan. This present obligation to transfer economic resources is recognized as a liability. So we can record the transaction as increased cash by 15,000. That means a plus 15,000 cash, and increase loan liability by plus 15,000. Now the entity is having a present obligation to pay interest and the principal repayment. Let's look at how we can analyze this business transaction. Bank loan repayment of 2,100 consisting interest payment of $100. Then we have to understand how much would be the loan repayment. That is 2,000, and the interest is given in this question as $100. So the total cash payment is 2,100. So we can split this into two transactions for the purpose of understanding. Loan repayment of 2,000. When we are repaying a loan, the cash decreases by 2,000 and loan liability decreases by 2,000. The business had a loan amount of 15,000 discussed in the previous slide. The business paid 2,000. Now the obligation is to pay the remaining 13,000. When recording business transactions in a worksheet one by one, we can easily calculate the remaining balances. Let's do one exercise after our initial example tutorials. Now let's move to the interest payment of $100. Of course, there is a cash effect of decreasing cash by $100. Then interest is an expense. So it decreases the equity by $100. If you can think the logic quickly, you don't need to do two recordings, two steps. Instead, cash asset decreased by 2,100. Loan repayment is only 2,000. So the loan liability decreased by 2,000. And the interest is an expense, so it decreases equity by $100. Now you may wonder about the duality concept. As in here, we identify three effects on the accounting equation. So don't get confused. Duality concept means every transaction must be recorded at least in two accounts. So there are possible scenarios, as in here, where we record in three accounts. Oh good. Let's move to our next example. Assets purchases on cash. These assets are mainly the inventories we usually see in the current assets in the balance sheet, but there are exceptions. Those inventories are used in the production or for direct sale. And also you will see property, plant and equipment that include land, buildings, machineries and equipments that last more than a year, which belongs to the non-current asset category. Okay, let's go back to the transaction. Purchased a new computer for $2,000. So cash goes out of the business. That means cash asset decreased. We cannot write off computer as an expense because we use them more than a year. Of course, we use a laptop for at least 3 to 4 years. Of course, it is more than a year, so it is an asset. So the laptop asset increased by $2,000. But in accounting, we don't list all individual asset items. Instead, we classify them in categories. In this case, laptop would be recognized under office equipment. In this particular transaction is one-sided, only affecting the asset side of the equation. But still, the equation balances. Asset goes up and asset goes down by the same amount. The next illustrative example is purchasing an asset on credit. Similar to the previous transaction, office equipment asset increased by $2,000, but this is purchased on credit. That creates a liability. So our accounts payable goes up by $2,000. Hold on. We are not yet done. Please go to the next tutorial to look at further examples to understand the effects of business transactions on the accounting equation.